Okay, Chapter 10, Reporting and Analyzing Long-Term Liabilities. All right, so we're going to focus on various types of notes and how to account for notes. We'll look at some debt features and their implications and learn how to compute the debt to equity ratio. And then we'll also go through some examples on how to prepare entries related to bond issuance and interest expense. And then amortization and discounts of bond premiums, or amortization of bond premium and discount, rather. All right, so comparing bond financing with stock financing. Okay, way back when, and towards the beginning of the class, we talked about how organizations can finance their activities through one of two ways, either through debt or through equity. Well, when you finance through debt, that's like issuing stocks, right? And we've talked briefly about some of that. Well, when you issue through debt or finance through debt, what you're issuing oftentimes are bonds. And so what'll happen is a corporation will issue bonds to investors, and those bonds will typically pay a semi-annual interest rate or some frequency of interest income over the course of the bond to whoever the bondholder is. So you have a bond issue date, and then from the issue date until the time the bond matures, you'll pay periodic interest payments to those bondholders. Okay, so the interest payment is typically computed as the bond par value times the contract interest rate times time. Okay, so advantages and disadvantages of bonds. So bonds do not affect owner control. The interest on bonds is tax deductible, and the bonds can increase return on equity. The disadvantages are that they require both periodic interest and par value payback at maturity, and the bonds can decrease return on equity. All right, so bond issuance. So this is a old school looking bond issuance certificate. So typically the bond issuance will state the number of bonds that are authorized, the par value, and their contract interest rate. And really what it represents is a legal contract between the bondholder and the issuer is called the bond indenture. So the bondholder may receive a bond certificate as evidence of the company's debt. Okay. All right, so here's an example of, I guess, explaining the idea behind bond trading. So for instance, this IBM bond quote here is interpreted left to right as bonds, the issuer name. The rate is the contract interest rate. So in this case, it's 4%. That's what the 4 means. It matures in year 2042. That's when the principal is paid. And then it yields a rate of 3.81% of the bond at the current price. The volume is the daily dollar worth of trades in thousands. So the volume is 110,000 in this example. And then the close price is the percentage of par value. The closing price of the bond at the end of the market day. It's the percentage of par value that it closed at, basically. So in this case, it closed at 103.08% of par. And that the change is the day over day, I think, from the prior day's close to the current day's close. It's up 0.73%. Okay. All right, so if we prepare entries to record bond issuance and interest expense, let's walk through what that looks like. So if we issue a bond at par, let's look at this example. So on December 31st, 18, the company issued the following bonds: par value of $100,000, stated interest rate of 8%, interest dates of 6/30 and 12/31, and it matures on December 31st, 2020. So when they issue the bond, they're going to get cash, and in exchange, they're going to have a bond payable. And so the way that we would record that is a debit to cash for $100,000, the par value, and a credit to bonds payable. Okay. And then when we make the interest payments, On June 30th, 19, the issuer of the bond pays the first semi-annual interest payment of $4,000. We're going to record a debit to bond interest expense and a credit to cash. So that's your 8% times your par value of $100,000 times half your year. And then every 6 months, the same entry is made until the bond matures. All right, so issuing bonds at par. When it comes time for the maturity of that bond that you issued at par, here's how this works. So on December 31st, 2020, the bonds mature, and the issuer of the bond pays the face value to the bondholders. So we're going to reduce our bond payable. We originally credited $100,000, right? So to reduce it, we debit for $100,000. We credit cash for $100,000. Okay. All right, so let's look at a couple examples here. So a company issues an 8% 2-year bond on December 31st, X1, par value of $7,000, and semi-annual interest payments. So on the issue date, the annual market rate for the bonds is 8%, which implies a selling price of $7,000. So prepare the journal entries to record the issuance, the first through the fourth interest payments on June 30th and December 31st, and the maturity of the bond on December 31st, 2000 X3. All right, so when we go to issue the bond, we're going to debit cash and credit bonds payable for $7,000, the par value, right? Then in letter B, the first through the fourth interest payments on June 30 and December 31st, every 6 months, we're going to record bond interest expense, 7,000 times 0.08, which is the interest rate, divided by 2, because that's annual, right? So every 6 months, you're paying half of that. So, and then you're going to decrease your cash every 6 months for whatever the interest expense is. It's money actually going out the door, being paid to your bondholders. So every 6 months, we're going to record a debit to bond interest expense and a credit to cash. And then on maturity, we're going to remove our bond payable from the books, and we're going to reduce our cash because we have to give that money back to our bondholders. So it's a credit to cash and a debit to bonds payable. Okay? All right, so bonds being sold or issued at par should be pretty easy peasy, right? Well, not every bond is issued at par, and so we need to talk about what happens when you issue a bond at what we call a discount or a premium. So the bond sets the contract rate, but the market sets the market rate. And so if the contract rate is greater than the market rate, the bond sells at what we call a premium. If the contract rate is equal to market rate, it sells at par. And if the contract rate is less than market rate, it sells at a discount. So let's talk about what we have to do with the difference between the contract rate and the discount or the premium that the bond's issued at, and how we account for that. All right, so FILA is issuing bonds with the following provisions: $100 or $100,000 par. Issue price is 96.4% of par. The stated interest rate is 8% and the market interest rate is 10%. So because the stated rate is less than the market, that means it's going to sell at a discount. Interest dates are 6/30 and 12/31. The bond date is December 31st of 18. Maturity date, 2 years later, December 31st of 20. So when they issue the bond, here's what happens. The par value is 100,000, but it's selling at 96.4% of that. So the cash proceeds are only going to be 96,400. That's 100,000 times 96.4. So you've got a discount of $3,600. And so here's the way that we record that. So we're only going to get $96,400 worth of cash. And we have a bond payable of $100,000. And so the difference is what we call discount on bond payable. So the discount on bond payable is a contra liability account. And that contra liability account is where the difference between the cash you get and the bond value gets recorded, or the par value gets recorded. Okay? So when you have a discount on a bond, Let's look at, well, so the way that it's presented on the balance sheet is you have bonds payable, less discount on bonds payable for the net carrying value. So it's kind of similar to accumulated amortization, where you've got the cost of your fixed asset less your accumulated depreciation, which is your contra asset account. Bonds are the same idea, just on the liability side. Okay. So, when it comes to, well, we'll get into the interest piece in more detail in the next slide. So basically, just pay attention here to the balance sheet presentation. Okay. All right. So here's what happens. So when you record that bonds, that contra liability account, discount on bonds payable, what happens is over the term of the bond, every time you make an interest payment, you're also going to amortize that discount. And so the carrying value of your bond is $96,400. But then as you amortize the discount, you're amortizing towards the par value. So let's look at how this works in more detail. So a company issues an 8% 2-year bond, par value of $7,000, semi-annual interest payments. Market rate's 10%, which implies a selling price of $96.46 or $6,752. So prepare the amortization table for the bonds using the straight line method to amortize the discount. Then prepare the journal entries to record the issuance of the bond, the first through the fourth interest payments, and the maturity on December 31st, 2000, X3. So the semi-annual period, you've got 1, 2, 3, 4, 5, well, including period 0, you have 5 basically interest dates. So the change in our carrying value is going to be $248 divided by 4 semi-annual periods. So that's the change between the 7,000 and the 6,752. So if you take $7,000 minus what you issued it for, the difference is $248, and you're going to amortize that over the semi-annual interest periods. So that's $62 per period, 248 divided by 4. So your unamortized discount starts at $248 upon issuance, and your carrying value is $6,752. Then every period, you're going to reduce your unamortized discount, and you're going to increase your carrying value. Okay, do you follow what's happening there? So we issue our bond payable, credit bond payable, debit cash. We have a bond payable of $7,000. We have a discount on bond payable of $248, which gets us to this net of $6,752. And then every period, every time we make an interest payment, we're going to credit our discount on bonds payable to take that to 0. And so our journal entries for the issuance is going to be a debit to cash for the $6,752, the discount on the bond for $748, and our bond payable credit for $7,000. Then our semi-annual interest payments are going to be bond interest expense and discount on bonds payable and cash. So every time you record your interest expense, which is going to be the sum total of your discount amortization and the semi-annual interest payments that you're paying your bondholders. So you have 7,000 times 8% divided by 2. So you have total cash going out the door of $280. Your discount on your bond payable is 62. So that means your total bond interest expense, including the amortization, is $342. So rather than having a amortization expense account like we do with some of our intangible assets, when it comes to bonds, we just record the monthly or semi-annual interest, semi-annual amortization of our discount. We just record that to the bond interest expense account. And you reduce your contra liability, discount on bonds payable, That's the other side of your entry. Okay? So you make that same entry for every semi-annual interest period. Then your interest expense is going to be your amount repaid plus the amount borrowed. So you have your 4 payments at $280, 1 payment of $7,000. Total repaid is $8,120. We borrowed $6,752. So our total bond interest expense ends up being $1,368. So then our last entry here is to record the maturity of the bond payable. So we're going to debit bond payable and credit cash. Okay. All right, so computing and recording amortization of bonds premium using the straight line method. So when the market rate is less than the stated interest rate, the bond's going to sell at a premium. Or rather, I should say when the stated interest rate is greater than the market rate. Okay. So when we issue bonds at a premium, on December 31st, 2018, Adidas will record the bond issue as $100,000 less the cash, or we should say rather, the cash proceeds are greater than the par value. So we're going to have a premium of $3,600. And so the way that we record that is we record a debit to cash to increase it, credit to bond payable because the bond payable is always at par, and then you have what we call an adjunct liability account. And so you have this premium on bonds payable of $3,600 credit. So the way that this would be reported, if you had just a premium, you'd have your bonds payable plus premium on bonds payable for the carrying value of $103,600. So they'll make interest payments every 6 months and they'll record the cash interest payment and the amortization of the discount when they do. So the way the amortization works is you start with unamortized premium, and as you amortize your premium, your carrying value decreases down to the par value of $100,000. Okay? So if we look at an example here, company issues an 8% 2-year bond on December 31st, X1, with par value of $7,000 and semi-annual interest payments. On the issue date, the market rate is 6%, which implies a selling price of 103.71 or $7,260. So we need to prepare an amortization table, then the journal entries to record the issuance, the interest payments, and the maturity. So same with the discount, just the other direction. You have your change in the carrying value is the difference between the par value of $7,000 and the selling price of $7,260. So you have $260 divided by 4 semi-annual periods for $65 per period. So as you are amortizing your premium, your carrying value is decreasing to the par. So you start at $260 and you have a carrying value of $7,260. That's the unamortized piece. As you amortize 65 of it, you get to $195. Oops. You get to $195, and then you reduce your carrying value by that $62 to get to $7,195. Then you reduce again by 65, reduce again by 65, reduce again by 65, and again by 65, and then you get to 0 in your $7,000 par value. Okay. So you got your original premium on your bond, which is $260, and that's a credit. It's an adjunct liability account. And as you amortize it, you debit to get to a net premium on bonds payable of 0. And your bond payable value doesn't change there. It just stays at $7,000 because the other side of your amortization of your premium goes through bond interest expense, right? So when we issue the bonds, we're gonna get cash of $7,260. We have a premium on bond payable for $260, so we credit that account. We credit our bond payable for the par value of 7. Then the interest expense again is the amount repaid minus the amount borrowed. So you have 4 payments of $280, 1 payment of $7,000. Total repaid, $8,120. Total amount borrowed was $7,260. So our bond interest expense is $860. So when we make our bond interest payments, we're going to record our reduction of our cash, which is the 7,000 times the 8% times 1/2 of the year, because you're making them twice a year. So every time you're going to pay your bondholders $280, so you're going to reduce our cash with a credit for $280. We're going to amortize our premium. Well, if we originally created our premium with a credit, we're going to amortize it with debits. So you have your premium on bonds payable is a $65 debit every period. And then you have your bond interest expense, which is basically your $280 less your $85. So when you have a discount on a bond, your bond interest expense is increasing by the amortization. When you have a premium on the bond, what it does is it actually reduces your interest expense. Because we'd be paying $280 in interest expense based on just how you calculate it, the par value times the percentage times 50% or half. So we really have $280 of interest expense, but the interest expense is being offset by the amortization of the premium, which is why we only have $215. Okay? All right, and then when the bond matures and we pay back our bondholders, we have a debit to bonds payable and a credit to cash. All right, so let's talk about bond retirement. So the carrying value of bonds at the end of their lives is equal to the par value. That's the purpose of the amortization and the discount. You're always amortizing towards the par value, okay, whether it's up or down. The retirement of the bonds at maturity then, assuming the interest is already paid and entered, is to just remove it off the books, right? Because any discount or premium is fully amortized at the date of maturity. So your carrying value is equal to your par value, so you remove your bond payable with the debit and you reduce your cash with credit, okay? But what happens if you retire your bond before maturity? So your carrying value, if your carrying value is greater than your retirement price, you have a gain. And then vice versa, if your carrying value is less than your retirement price, you have a loss. So assume that $100,000 of callable bonds will be retired on July 1st after the first interest payment. So the bond carrying value is 104.5 and they have a call premium of $3,000. So the way that we would record that is you're going to remove your bond from the books because you're retiring it. So you debit your bond payable. The bond carrying value is 104.5, and because you know the par value is 100, that must mean the premium that's still on the books is 4,500. So in order to get rid of your premium, which is an adjunct liability, meaning it has a normal balance of a credit, in order to remove that from the books, we have to debit our premium on bonds payable for 4,500. The cash is going to be equal to the par value plus whatever the call premium is. So you're going to receive $103,000 worth of cash. So you're going to pay, sorry, $103,000 worth of cash. So we're going to credit cash. And so then the difference is just gain on bond retirement. So that's your $1,500. That's your plug to make your debits and your credits work. Okay. Two common ways that we retire bonds before maturity is either to exercise a call option or purchase them on the open market. So in the first instance here, in the exercising a call option, the issuer can receive a right to retire the bonds early by issuing what we call callable bonds. And so they have the right to call those bonds back really at any point in time. So the bond indenture, the issuer can give the bond indenture can give the issuer an option to call the bonds before they mature by paying the par value plus a call premium to the bondholders. So that's what's happening here. And then in the second case, when they purchase them back on the open market, it's pretty unlikely that they'll pay a price that equals exactly their carrying value. And so when that difference exists, the difference between the bond's carrying value and the amount paid is just gain or loss. Okay. All right, so bond retirement. So there's also this idea of convertible bonds, where they can actually convert their bonds to stock. And so when that occurs, the carrying value is transferred to equity accounts and no gain or loss is recorded. So in this example, where conversion of bond let me say it a different way. When bonds are converted to stock, let's look at what that journal entry looks like. So on January 1st, $100,000 of par value bonds at Converse with a carrying value of $100,000 is converted to 15,000 shares of $2 par value common stock. So you got to get rid of your bond payable, right? Because you're converting it to stock. So you just debit bonds payable for the par value. But when you convert it to stock, if you remember, I don't remember what chapter that was, but what gets recorded to your common stock account is just the value, the par value, right? And then everything above par is what we call paid in capital in excess of par. So the common stock credit is going to be equal to 15,000 times the $2 par value. So that's 30,000. But your debits have to equal your credits, right? And so everything else becomes paid in capital. And so that's where the $70,000 credit to paid in capital comes into play. All right, so let's explain the type of notes and prepare entries to account for notes. So note payable, long-term notes payable. So a company gets cash from a lender. They have a note payable. So when the repayment of the principal and interest are going to be made is between the note date and the note maturity date, right? Typically on a monthly basis. So there are some notes that the principal and interest are paid in a single payment at the end of the term. I don't know how common that is. I know all of our debt at NRI is all monthly payments. Now sometimes the monthly payments they may be interest only payments. Typically on construction loans, that'll be a common thing. But ultimately any long-term permanent financing, you're going to make an interest and a principal payment and you're going to do it every month. Okay? Kind of like your mortgage, right? So regular payments, you're going to make regular payments of principal plus interest to the lender every month from the date of the note to the date the note matures. So an installment note is an obligation of a series of payments to be made to the lender. So they're common for franchises and other business when lenders and borrowers agree to spread the payments over several periods, right? So very similar to your mortgage. On June 1st, 18, Fog Hog borrows $60,000 from a bank to purchase equipment, signs an 8% installment note requiring 3 annual payments of principal plus interest. So the way that we compute, well, let's back up a minute. When they issue the note, we're going to credit cash and debit note payable, okay? And then the way that we figure out what the interest payments are is we're going to compute the periodic payment by dividing the face amount of the note by the present value factor. So they come from, there's all kinds of tables. I think if you have any of these problems, both on the exam or in the homework, they will give you the factors that you need to be able to compute the interest. But nevertheless, the periodic payment is basically computed by dividing the face amount of the note by the present value factor. So the $60,000 divided by the present value factor be a payment of $23,282. All right, so the slide shows a pattern of equal payments here and 2 parts, principal and interest. So column A is showing you the balance. Column B is showing you the interest expense. See the difference, right, for the total payment, $23,282. So if you look at the picture they're trying to show you there with the bar graph, basically what happens over the term of your loan, you're going to pay the amount of your payment that's being attributable to interest decreases, and the amount of your payment that's being attributable to principal increases, right? It's typical amortization. So let's look at what happens with the journal entries. So Installment notes with equal payments. So let's record the first payment made on December 31st by Fog Hog to the bank. So based upon that amortization table, we're going to have interest expense of $4,800. We're going to reduce our note payable for the amount that got applied to the actual principal balance, $18,482, and we're going to reduce our cash by $23,282. And then when we make our next payment, we have our interest expense of $3,321, debit our note payable for the amount that's getting applied to interest from our payment, $19,961. We're going to credit cash for $23,282. Right? All right, so a mortgage is a legal agreement that helps protect a lender if a borrower fails to make payments, right? So if you own your home, you probably have a mortgage. Basically what it does is it gives the lender the right to be paid out of the cash proceeds from the sale of the borrower's assets specifically identified in the mortgage contract. So you don't pay the mortgage, they're probably going to take your house, okay? All right, so let's look at this example. So on January 1st, 2000X1, the company borrows $1,000 cash by signing a 4-year 5% installment note. The note requires 4 equal payments of accrued interest and principal on December 31st each year from 2000X1 to 2000X4. So compute the amount of each of the 4 equal payments. So the present value of an ordinary annuity is $1,000. This is the formula, $1,000 divided by the present value of ordinary annuity, where the term is 4 payments and the interest rate is 5. Okay, so we look at the present value of an ordinary annuity table. We look at the intersection of 5% and n is 4. So we have 4 periods here at 5%, right? That's where we stop. So it looks like our present value of an ordinary annuity of 1 is 3.5460. So 1,000 divided by 3.5460 equals your payment. We're going to make a $282 payment each of the 4 times. So if we prepare the amortization table, we have a beginning balance of 1,000. We have interest expense of 5%, but keep in mind this is a semi-annual, oh wait. No, that's right, sorry. We're not dividing by 2, it's an annual payment. So we have $1,000 times 5% is $50 in interest. Well, if our payment's $282, 282 minus 50 is $232, right? So that's what's hitting our principal. So if we have $1,000 less our principal payment of $232, we get $768. So we start at $768, we multiply it by 5%, we have $38 of interest in payment 2. 282 minus 38 is 244. 768 minus 244 is about ending balance of 524 after that payment. Then you have 524 times 5%, so that's $26 of interest. If we have 282 as our payment minus $26 of interest, we're going to have $256 of principal in that third payment. So 524 minus 256 is 268. We have 268. But really, the final payment, if we're paying $282, that must mean if we're going to get to 0 after the 4th payment, 282, you need $268 of principal, and so then you back into the interest of $14. Okay. All right, so to prepare journal entries to record the loan on January 1st, 2000X1, and the 4 payments, here's what we do. So the initial receipt of the cash and establishment of the note, we're going to debit cash for 1,000 and credit notes payable for 1,000, right? Then in the first interest payment, we're going to take our $50 of interest expense, our $232 reduction in principal, debit both of those, and credit cash for $282. Then the next month, we have a interest expense of $38 and a principal pay down of $244. Cash out the door of $282. so on and so forth, right? So you're just tracing these, or you're just putting these numbers here, the interest and the principal, and a journal entry form. Okay. All right, so assessing debt features and their implications. All right, so features of bonds and notes. So secured or unsecured bonds and notes have specific assets of the issuer that are pledged or mortgaged as the collateral, right? So if the issuer fails to pay the interest or the par value, the secured holders can demand that that collateral be sold and the proceeds be used to pay the obligation. Unsecured bonds and notes, also called debentures, are backed by the issuer's general credit standing. So unsecured debt is riskier than secured debt. And then term or serial bonds mature on one specified date. So serial bonds and notes mature at more than one date. So term or serial bonds mature on one specified date. Just straight up serial bonds mature on more than one date. So they're often in like a series and usually repaid over a number of periods. So for instance, if there's $100,000 of serial bonds that might mature at a rate of $10,000 per year from 6 to 15 years, maybe after they're issued, right? That would be an idea. That would be an example of those that are paid over multiple periods. And then sinking fund bonds, which are basically to reduce the holder's risk, require that the issuer create what we call a sinking fund of assets to set aside specified amounts and dates um, to repay the bonds, basically. Okay, and then registered or bearer are bonds that are issued in the names and the addresses of their holders. They're registered bonds. The issuer makes bond payments by sending checks or transfers to the registered holders. So the bond payable to whoever holds them, the bearer, are called bearer bonds or unregistered bonds. So sales or exchanges might not be recorded. So the auditor of or the holder of a bearer bond is presumed to be the rightful owner. Okay, so as a result, any lost bearer bonds are really difficult to replace because whoever has it is assumed to be the owner of that bond. Okay. I don't know, I think that's a super summary. You can read more in the book about the different features of bonds and notes, but that should give you a good summation anyway. All right, so debt to equity ratio, let's talk about that. So debt to equity ratio, so it's computed as total liabilities divided by total equity. So it helps investors determine the risk in investing in a company by dividing its total assets by its total equity. So again, there's not it's just a measure of risk, and there's not really a right answer, so to speak. It's just telling you how much the company is financing their operations by debt versus by equity. Okay, so it looks like here Nike and Under Armour in 2016 and 2015, looks like for every 75 cents, or for every dollar of equity, they have 75 cents in debt, right, roughly. In 13, it used to be 50 cents, so it looks like they are choosing to finance their operations more through debt than they once had in 2013. But again, not necessarily bad one way or the other. It's just really a measure of risk, I guess. All right, so we're not going to get into Appendix 10A. If you are interested, feel free to look through it, but there will not be anything on the exam related to Appendix 10A. So I hope you found this information to be helpful. As always, if you have any questions, please don't hesitate to reach out. And I think the bonds issuance and amortization of discounts and premiums will become more clear as you work through the exercise PowerPoint. So after you've listened to this and have a solid understanding or introduction to the material of Chapter 10, then why don't you go ahead and listen to the Chapter 10 exercises, and they'll go through a bunch of examples to help kind of send those concepts home. Okay? All right, take care, guys.